Hey everyone, Couch Investor back to our earnings video for today. So Netflix just reported their earnings report and it was another pretty good print. The stock is up around 9 to 10% at the time of making this video. And so if we look at the graph, of course, in the last couple of weeks, we've reached that resistance point around $440 or so. Since then, we went all the way back down under the 200-day moving average, which was not that great. Then now we jump that 9 to 10%. So we're just over that 200-day moving average, which was also previously a little resistance point at around $365, $370 or so. Of course, for long-term investors, you shouldn't really care what happens in the short term, but it does give you maybe better entry points, better points where you can dollar cost average, because probably after you've seen that big red candle, you said, okay, $400 seems good enough, but no, it went down another 10% or so. Now, with regards to the highlight numbers, it's a beat when it comes to EPS and inline / small beat when it comes to revenue. Now, the analyst estimates for fiscal year 2024 is sales growth of around 12.8%, and then another close to 11% for fiscal year 2025. But if we go to EPS, we can see that EPS, underlying the bottom line, is growing much faster. We've seen that with a lot of companies, especially right now in the harsh macroeconomic environment. They are focusing more on profitability, and we've seen that with Netflix already for a while. We see that free cash flow keeps on increasing, which also helps with buybacks. So for fiscal year 2024, the expectations for growth there is 26.47%, and then another 28.88% for fiscal year 2025. Pretty good if you ask me. Now, of course, some might say, look, the stock has gone up already a lot. The company still has a lot of debt. There is the strikes, etc., etc. Just don't feel comfortable with the whole streaming dynamic either. So I'm going to pass on that. And fine. But if you want a stock, a company in your portfolio that is focused on streaming only, that is going to be a pretty big player, in my opinion, when it comes to advertising, I mean, you cannot go wrong with a company like Netflix, even though the stock has gone up already. I mean, year to date, it's up 17.43%. Since last year, it's up 43%. And of course, since the time where everybody called Netflix a dead streaming player, it probably doubled. So there is that. Always said this is a great company, but a pretty misunderstood one. So let's have a dive into that earnings report. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not. We're well on our way to reach 30,000 subscribers. So let's try and reach that before the end of the month. Thank you very much. And if you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So at first, I want to touch on what they say here, the adoption of the ads plan that continues to grow, with ads plan membership up almost 70% quarter over quarter, and 30% of signups in their ads countries are on average to our ads plan, with more work to do to scale this business, but hey, this is a pretty good start. Now, when it comes to the highlight numbers, of course, we're going to talk about competition, engagement, the strike effect, etc., later on in this video. But revenue for this quarter increased 7.8% year over year. Operating income came at $1.91 billion, and so operating margin 22.4%. Again, these numbers are better than their forecasted numbers that they gave us last quarter, so that's always good. Net income $1.67 billion, and so diluted earnings per share $3.73. When you look at global streaming paid membership, we have increased that by 10.8% to reach 247.15 million. And so they added 8.73 million this quarter. When it comes to net cash provided by operating activity, $1.99 billion, free cash flow $1.88 billion, and so you can see free cash flow keeps on increasing quarter over quarter. Of course, in Q1 here, you see that big increase for that one quarter. But before that was just $472 and $332 million. But I mean, we've seen the margin improvements as well in each and every quarter. But we're going to have a talk about free cash flow a bit later as we talk about the spending on content for 2024 with regards to the strikes. Now, when it comes to forecast for Q4, they expect revenue to grow 10.7% year over year to reach $8.69 billion, operating income $1.16 billion, and operating margin of just 13.3%. So a big decrease here. We're going to talk about that a bit later. Net income $956 million, so diluted earnings per share $2.15. So, the forecast. So, their goal is to accelerate revenue growth, expanding operating margin, and deliver growing free cash flow. 9 months through the year, we are well positioned to meet these objectives in 2023. Now, they say here over the past few months, the US dollar strengthened versus other currencies, representing roughly $200 million expected drag on Q4 revenue and ARM, which is included in the forecast. Now, in terms of profitability, they are updating the fiscal year 2023 operating margin guidance forecast to 20%, the high end of their prior 18 to 20% forecast based on FX rates on the 1st of January. This would mean that our operating margin would increase approximately 2 percentage points from our 18% operating margin in fiscal year 2022. Assuming no material swing FX rate, we currently expect an operating margin in fiscal year 2024 of between 22 to 23%. So another increase here for the next fiscal year, very well received by the market. Then when it comes to engagement, as always, they give us here a nice graph by Nielsen. They say here that in the US, for example, they had the most watched original series for 37 out of the first 38 weeks of 2023, and the most watched movie in 31 of those 38 weeks, according to Nielsen. Similarly, our share of TV time in the US was 8% in September, which is greater than any streamer other than YouTube, and we believe it gives us a substantial room for growth as we continue to improve the quality of their slate. I mean, it's pretty impressive, and it's still early days when it comes to streaming. Of course, we've been talking about streaming for a long time, but in my opinion, we're still early days there. Here they talk a bit about the success of One Piece. I mean, I'm very happy that One Piece was actually a pretty good show, because adaptations from anime to real action TV shows or movies, it's usually pretty difficult, but hey, they nailed it this time. Now, when it comes to licensing, of course, we've seen this. If you have Netflix, you've probably seen Suits already on your homepage for a long time. So they say here that according to Nielsen, Suits was the most watched title across film, original TV, and acquired TV on streaming in the US for 12 weeks starting in late June. That's 614 million views hours, a new Nielsen record. Over the same time frame, Suits generated 1 billion views hours on Netflix globally. I mean, it's pretty impressive when you think of the fact that, well, Suits was a TV show that ran between 2011 and 2019. So now in 2023, to get that amount of viewing hours, it just shows you the power of Netflix, and it definitely will show advertisers, another reason why they should invest their advertising dollars with Netflix. Then they go on to talk about the sporting aspect of the streaming platform. So shows like Breakpoint, Quarterback, Beckham, Pele, Drive to Survive, Full Swing, etc., even Tour de France, how that has a positive effect on that sport, how that increased the conversations online on social media. Of course, the effects here of Netflix are well known, especially when it comes to Formula One. And then they announced this, they actually released this trailer, I believe, yesterday, so the Netflix House. So over the next few years, we will be developing Netflix House, physical flagship destinations that combine fresh, new live experiences as well as food and retail, so fans can visit many times a year, safe in the knowledge there will always be something different for them to enjoy. I mean, does this sound familiar? Disney parks, Disney experiences? I've been saying this for a while. I think Netflix will be working on something like that. Maybe not like a Disneyland, but hey, this is already a pretty good start. Of course, do share your opinion down in the comments below. Then when it comes to monetization and growth, so first, paid sharing. They say here we're revenue positive in every region when accounting for additional spin-off accounts and extra member churn and changes to our plan mix. Then with regards to pricing, while we mostly paused price increases, we rolled out paid sharing. Our overall approach remains the same, a range of prices and plans to meet a wide range of needs, and as we deliver more value to our members, we occasionally ask them to pay a bit more. Of course, you have options, different options, ads, basic, standard, premium. The price range here is pretty impressive, so hey, they give the option for a lot of people to actually buy their subscription. Then with regards to ads, which in my opinion is pretty important here, so this has been less than a year since the launch. While we have much work to do to build out this business, we are making good progress and laying the foundation for what we believe should be a multi-billion-dollar revenue stream over time. They say here in Q3, our ads membership increased nearly 70% quarter over quarter and now accounts for around 30% of all new signups in our 12th ads country. Bodes well for the future. Now, with regards to cash flow and capital structure, they now expect free cash flow for fiscal year 2023 to be approximately $6.5 billion, up from their prior forecast of at least $5 billion and versus $1.6 billion in 2022. Now, this includes around $1 billion in lower than planned cash content spend in 2023 due to the strikes. As a result, we expect 2023 cash content spend of around $13 billion, and assuming that the strike is resolved in the near future, we are currently expecting cash content spend of up to around $17 billion in 2024. As we said last quarter, these strikes will create some lumpiness in free cash flow over the 2023-2024 period, but we plan to deliver very substantial positive free cash flow in 2024. Then, with regards to the repurchasing of their own stock, they repurchased $2.5 billion of their stock, or 6 million shares, under their original $5 billion authorization. Now, since the inception of this authorization, they've bought back $4.1 billion, and in September, the board increased the share repurchase authorization for an additional $10 billion, on top of the $1 billion remaining under the prior authorization. And here you can basically see why Netflix right now will just stay king of streaming for a long, long time, because the early players, the Disney Plus, the other ones, are probably still stuck in the free cash flow burning type of scenario, while Netflix are out of that. Remember, Netflix is streaming only. It's a bit like Tesla, it's EV only, don't have to deal with the ICE, or in this case, the linear business. And you can see that, well, operating margins have increased quite nicely, and so did free cash flow. So to conclude, what is there more to add? Netflix is the king of streaming, and I do expect them to stay the king of streaming in the future. They'll just become more and more profitable. I just hope that they can still make more and more quality content instead of, well, what we believe to be not that great of a content, to put it lightly. Of course, if you're a Netflix shareholder, do share your thoughts down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.